started a business, ran around for investment. Remember, I met with a guy who I kind of blagged that I knew, this investor off Secret Millionaire. And I sort of said, you'll not remember me, but I saw you at this event, way back when. And I've got this opportunity if you want to meet and have a coffee. And he said, I've never met you ever in my life, but I like that you're cheeky enough to try it on. So I met him and got 100K investment. Having a trading business will make lenders, investors just super easy to deal with. Have a business first and property second. And then in times of difficulty, when businesses are not doing very well, your property portfolio can support business and money can go backwards and forward. Because the legal process is the same for a 50 grand deal as it is a £5 million deal. You can learn everything in an environment where you can control things if they go wrong, especially if you're starting out.
I think people listening to that need to understand that that does happen, but you're still here, you're still alive. In fact, you're probably more successful because of what you went through. Mark your calendars. The 2025 Property Developer Show is coming to 5 major cities across the UK, bringing the best service providers and developers together under one roof. On the 5th of March, we kick off in the first show at Milton Keynes, followed by Bristol on the 30th of April, Birmingham on the 16th of July, and then we're heading north to Manchester on the 10th of September, followed by our final stop in Newcastle upon Tyne on the 15th of October. Don't miss out on connecting with other developers, service providers, and industry leaders. Visit propertydevelopershow.co.uk to book your free ticket today. Welcome to another episode of the Property Developer Show, the podcast. Today, I'm joined by Nathan Winch of Winch Co. Winch Co is a private equity firm. Nathan has invested in haulage, timberworks, all sorts of stuff, blue bricks, just to name a few, and also is a property investor. Nath, welcome to the show.
Thank you. Thanks for having me. Fantastic.
Pleasure. So I think where the usual starting point is sort of your journey in a sense of business, because obviously you're doing property and business, mostly business rather than property. So we'll start with how you kind of started your career and then how you ended up sort of moving into property and then the private equity stuff as well.
Yeah, definitely. A trip down memory lane. So sort of started out kind of cliche like most people do. So I was at university, my background sort of molecular biology, totally left field to most things that I do now. And I was at university, did a sort of gap year in the NHS. So worked in research and development for female ovarian cancer, but that's unnecessary detail. But I sort of was doing more and more as part of that role. And as part of that role, I had to do the procurement for my department, or some of it. And I sort of started looking through the NHS supply chain, which is the central framework where all hospitals, research centres, everywhere's got to buy from. And I was thinking things are like really expensive. And I was speaking to some nurses because we were down by, this is in Leeds, so we were down by the LGI, the hospital. I was talking to some nurses and they say, oh no, we pop down to Asda to get things like gloves and stuff because it's cheaper than, where the NHS is told to buy from. So I was like, oh, this is interesting. So I started looking more and more. And I always have this analogy, and I can't remember whether it's true or not, but I was like, I had to buy a fork or something like that. And it was like £4 or something for this little consumable item. And I thought, that's just absolutely bonkers ridiculous. It's no wonder the NHS has got no money. But this was years ago. This was like 11, 12 years ago. So I thought, well, let's have a look on the supply chain, how it works. So I did. And I thought, there's only big companies on there. It was like a big monopoly with certain companies, And I thought, well, how hard can it be to sort of sell on this sort of framework? So I'd had a bit of, I guess, entrepreneurialism earlier in my life. Like I did sort of some web development in university, started my school's first newspaper and stuff like that. So there was always something there, I guess, in the background. Mm-hmm. But I am a scientist. I am a methodical person. So I kind of try and put the two together. So I thought I'll bid on a contract, how hard can it be? Something simple. And so I did and, learned the lingo, the language and all the rest of it. And I bid on a contract and then ended up winning, which I honestly didn't expect to do. And we won this share of like a £40 million contract. And I was a student. I hadn't even done my final year of uni, had absolutely no money, hadn't even incorporated a business. And I was like, right, shit, I need to get started and do something with this.
Yeah.
So started a business, ran around for investment and things like that. remember I met with a guy who I kind of blagged that I knew, this investor off Secret Millionaire. And I sort of said, "Oh, you'll not remember me, but I saw you at this event, way back when, and I've got this opportunity if you want to meet and have a coffee." And he said, "I've never met you ever in my life, but I like that you're cheeky enough to try it on." So I met him and got 100K investment.
Wow.
And that kicked off the business, and that was the first time I properly, had a business. And it grew quite slow because the NHS resistant to change. But it grew to a point where we had a supplier who was struggling to get into the NHS, and they thought, well, the quickest way to get into the NHS would be to buy your business. So I sold that business. I think it was 2016, and yeah, sort of went from there really. Bought my first property then as well. I think it was 2015, 2016 for my mum. Just normal deposit down, buy to let, vanilla sort of thing. And then it went off the back of that really. So started buying property as kind of a pension. But then got a bit bored, did some consultancy, started another business, sold that, and then kind of thought, well, maybe a better thing would be to buy things rather than start them because it's a shorter time horizon to a like a liquidity event or an exit. So started doing that, and then I guess the rest is history, I suppose.
Amazing.
To keep it because I could talk all day, but to keep it in a relatively short introductory nutshell, that's pretty much it, yeah.
Amazing. I think that's like the true entrepreneurial spirit, isn't it? It's seeing an obstacle, realising that there's potential with that obstacle, and then just literally no thought, I'll put in for a tender. I've got the tender.
Yeah.
Now I've got to swim.
Yeah,
sink is not an option.
No, that's it. Yeah,
I think that's credit to you as an entrepreneur, and certainly something that people should look towards to get inspiration if they're struggling to get started, particularly. So, on the nature of kind of running things as they are, I think it's probably good to give an insight to what you've actually got spinning at the minute, so people can understand what you've got going on, basically, which I know is a lot.
Yeah, it is actually. It blows my mind every day, but. So we own a sort of a small portfolio of businesses. So we've been in and out of a lot of stuff. We've had some stuff work really well. We've had some really disastrous stuff. But luckily the stuff that's working really well is much more than the stuff that hasn't worked. So at the moment we call them assets, but they're just businesses. We've got businesses in warehousing, distribution, logistics. So we've actually just acquired recently in September another small logistics firm. We're in a bit of a roll up with that at the moment, buy and roll up. That's pretty big now, actually. We own a timber construction firm in Manchester, just across the way. And we've got several various kind of angel investments in different things. You mentioned Blue Bricks, that's one of them. And we own a small energy company as well. So in the sort of the EV car charging space, and renewables. So, doing a lot actually, and that's like managers to fill every day.
I bet.
So yeah.
So juggling that as well as sort of investing in property, how do you sort of find the balance between the two? I know obviously I discuss on this podcast quite a lot about wealth creation and wealth preservation and how they obviously come hand in hand. How does that sort of, I suppose, transfer to the way that you operate things?
Well, I think. I always say you should have a business first, before you go into property. To make property your main thing from a standing start is incredibly difficult. So I have grown quite a significant portfolio, mainly commercial, but that's stuff we've inherited, or it's like when we've bought a business, it's come with a proper, like a freehold or something like that. So we have to do something with it, or consolidate. So, I'd always say having a trading business will make lenders, investors just super easy to deal with. If you're actually making money from a going concern, it's pretty easy to buy and sell property and to borrow lots more as well. So I'm always an advocate of have a business first and property second. And then in times of difficulty, when businesses are not doing very well, your property portfolio can support business in, like money can go backwards and forwards. So that's kind of my mantra, I suppose. And it's worked well for us.
So when you're kind of approaching the whole business acquisition piece, obviously the property part, I'd imagine that's quite a big part. Are you keeping that sort of within the businesses that you're acquiring, or is that sort of something that you're acquiring through that and shifting it into your own limited company, or like what's the sort of structure with
So it's a mixture of both, really. I mean, we work on a lot of turnaround projects, so they're kind of like high stress. We're trying to make things work that haven't historically worked. But we do have businesses that we buy that are profitable. I guess with that, it all depends on what the aim is for that particular strategy, right? So if we're saying we're buying these businesses and actually the freehold property, we're happy with just being a tenant, sometimes we might sell them. So once we bought the business, we'll sell the property. That's quite common in the line of work that we do, because that often then pays off any acquisition finance, so that then you know, and it's that sort of thing. But yeah, we tend to kind of restructure property into kind of a central holding platform, so that if we then sell businesses, we retain the properties that they're in. So we'll set up lease agreements and things like that to add internal value. But that's also accretive value, because once you've sold the business, there's a continuous, you know, depending on how strong the covenant is of the tenant, the commercial tenant, that could be a strong, you know, commercial property asset. So a bit of everything, really, I would say. But we like to hold property where it makes sense. And like you said, in terms of having a trading business, we tend to be owner-operators where we are. But that doesn't get us out of huge commercial refurbs and buying and selling and doing all different weird and wonderful things. And we've got a residential portfolio as well, which admittedly is smaller than it was. We've chosen to sell some of that in light of the sort of the economic landscape over the last sort of 3 years. But commercial is kind of, we're big into that, just with the nature of what we already do. Yeah,
absolutely. Because I've seen you add a few bit of concrete, or I say a bit of concrete.
Yeah, that's the bane of my life, concrete. But yeah, we're getting there. We're getting there.
Good. So in a sense of, I guess, as well, kind of leaning on that commercial property element, and I suppose I use like Morrison's as an example. Recently, they had to raise capital, so they sold all their commercial premises to, I'd imagine, a hedge fund. I'm not too sure they sold it to be honest, to raise that capital and then paying the lease on those commercial properties rather than being the freeholder. So I suppose from a business perspective, it allows you to have that kind of fallback if you're in a position where you need to raise capital for whatever reason. I guess it gives you that kind of mitigation. Yeah, I suppose.
Yeah, or borrow. So it's the same as with Asda, right? I mean, they funded, I think the Easter brothers, they bought Asda probably quite a while ago now, but they funded around 90% of that by selling all of Asda's freehold property, which funded the purchase. So it depends what your strategy is. You know, people tend to be owners or lease, hire purchase. You know, you tend to be in one or other of the camps. But yeah, property is certainly very important, but it shouldn't be the only thing, I don't think, from my experience anyway. It can be incredibly helpful, but as part of a wider trading business, it can really boost what you want to do and give you options. Yeah,
absolutely. So did you find that investing in property, kind of any skill sets have shifted over, or the knowledge that you sort of gained has been impactful for that?
Doing deals, being a bit more creative with deals. So things like options. I mean, I do a lot of options agreements. That comes primarily from business, really. It's not a tool that's really been used in property until like the last 20 years. It's mainly been for like options on shares in businesses and things like that, you know. And it's sort of created this derivative that you can then sell. So I've also done sort of option agreements where I've got the option on something with the intention of selling the option, because it gives some, you know, another investor an in for something strategic or something like that. So it's a really dynamic tool. So I guess that sort of stuff came across and helped me expand the portfolio in a way that actually required less capital up front, so that I could invest capital after the purchase, because you always need capital at some point. And the idea of reducing your initial upfront cash burden is to have that money to then invest in whatever you're going to inherit, and there will be problems, you know.
So approaching like an asset-backed business, which is what obviously the logistics businesses pretty much are, from a kind of valuation perspective, how are you sort of looking at the metrics with that? Obviously, you've got the EBITDA in terms of the income of the business, but also then the asset side of it. So I guess for people that are maybe looking at acquiring businesses, I guess, that also have that kind of asset back, from the kind of valuation approach, are you looking, right, okay, well, there's £1 million worth of property. Can we loan against that or raise money against that to obviously acquire the actual business itself based on the EBITDA? Like how is that kind of looking from your methodology?
I suppose it's not one size fits all, obviously, but you tend to look at the industry. Is it like commoditized like transport is? Like, is it something that's just, there's lots of it and you just have to be price competitive? Or is it something a bit more IP driven, like with intellectual property? But you're usually with a normal business, you're usually within the region of 2 to 3 times EBITDA plus net balance sheet would be a great starting point for evaluation of a business, a typical business. But then you have things like, long-term contracts with customers, recurring income. These things can all increase the value, and how debt-free is the business and stuff like that. So yeah, that's a typical starting point. And then the property and things are usually included in the balance sheet, but they might be at historical cost level. So you might then have to barter with a seller over, well, the property's worth this now, yeah, but you've depreciated it, and so there's all this different weird and wonderful stuff, and that's what we've sort of got our commercial team for, to analyse that sort of stuff. But yeah, that would be a starting point in terms of a value, and then we'd go from there. And more often than not, a seller will have different price expectations based on what they need to retire on. It's never to do with the value of the business. So we've got to kind of combat that as well. But yeah, I think our sort of method works, and we kind of get ownership from the seller over what the price should be, and get to it that way, really.
Absolutely. I'm just conscious that I've got to make it about property because we're on a property podcast, of course, but it's hard to because
we did say this. The
business topic is I'm itching away to ask those types of questions, and I'm sure most of the listeners, have that balance. They're typically a business owner, or they're very driven in their own corporate role, and I suppose having that insight to how your skill set from property has transferred into doing what you've done. And I suppose what you'd learned prior to that has just allowed you to plug into the property industry.
Yeah, absolutely. We're doing a big refurb at the minute. So we've acquired a distribution centre in the north, and we're sort of refurbing that to build equity. So I'd got that on an option, and we're refurbing it, adding the value. We're expecting to create, several £100,000 worth of equity, and then we'll either sell that with the option, or we'll execute on the option. Give us different ways to skin a cat, really. So we build that in. Property is a really important part of what I do, actually. So I think it is relevant in a sense that for longer term, what we call accretive growth, which is, I think some people call it fast pounds, slow pounds. So accretive growth is growing your slow pounds. So the capital appreciation over longer extended periods of time, which is good for things like pensions, retiring and stuff like that. So there's a strong focus on that as well. It's not just the trading assets, it's the properties as well that we've ultimately got to operate from. So it's like with the energy business, for example, we operate an electric vehicle car charging network. So as part of that, we acquire properties strategically located, or we work with property developers a lot of the time who might have car parks, they might have residential or commercial developments, and we kind of go in and say, look, we'll take some of your land for this. You get a benefit of extra footfall, a different diverse audience, that kind of thing. So property is a huge part of what we do. Yeah.
Just very quickly interrupting this episode. Have you got a property deal in mind? Want to build or grow your portfolio but unsure how to obtain funding? No problem. At Roma Finance, they love to lend. The borrower first approach means Roma deliver flexible, tailored solutions that accommodate the diverse needs and experience of developers across residential and commercial projects. With a flexible criteria, Roma take time to understand each borrower's unique circumstances. Roma's attentive team are always equipped to handle and take on your requests. They will guide and support you throughout the property journey. Colleagues and customer relations are the beating heart of their business. Don't forget to explore Roma's website, romafinance.co.uk, for helpful resources, including articles and case studies to guide your financial decisions. Remember, Roma Finance love to lend. Your property goals are only a call or email away. Now back to the episode. And I suppose the two come hand in hand, really, don't they? And at that wealth creation, wealth preservation point. So I guess my question is going to be, what advice would you give to someone that's maybe sort of, I guess, trying to make that momentum in, I know you alluded business first, then property. Just go into more detail with that sort of.
So I think to start with, property is a fairly low return on investment. Like normally, if you keep it dead simple, you've got to go in it with lots of cash, probably particularly more over the next period, depending on how the economy changes. So when you're deploying large amounts of capital, obviously your return's lower, right? That's how it works. So you can have leverage. So one of the best ways to look at it is what return is it on the deployed capital, not the employed capital. So what I mean by that is that what are you spending to buy a property as a whole in terms of from the seller's point of view versus what you're actually spending of your own money. So the two are quite different. So let's say you're buying £1 million property. We assume it's commercial. So commercial tends to be 30 to 40% deposit. So you're putting 400 grand down, but actually you're deploying £1 million. So just because it's the bank's money or it's your money or it's investor money, you are deploying £1 million. So you should really look at the returns and yield on the £1 million, not the 400k. Because I think you're kind of making it make believe. Yeah, if you can make you will have a return on that 400k equity, but then have you got a return on your bank debt as well? People probably don't even think of that. You know, you're just looking in isolation at the return on your equity. Well, actually, you need to look at the return on your overall cash deployed. And if that's sort of lower than 7 or 8%, it's probably not a good investment. Because you've got to think about stress testing it with, you know, interest rates changing. Are you on a variable rate? You know, is it a bridge? Have you got retained into, you know, all this sort of stuff. So it's probably better to look at it at a higher point of view and test it against, you know, metrics that are percentage of yield on the whole value, rather than just thinking I'm making a 20% return because I've only put 20 grand into this property of my own money and I'm making X. That's all right in good interest rate environments and stuff like that, but you need to kind of look at what's your actual return on cash in the deal overall.
Absolutely.
That's kind of where we come from.
That was my sole reason why I shifted from being a landlord into just developing houses, for that prime reason that I felt I could move quicker and build capital and cash quicker, because that deployment time frame is lesser, and I crystallize my return on profit, which means I can do bigger projects, means I can invest more. And if I can churn that quicker, my return on investment over the long term, if factoring, you know, debt, everything else, risk, blah, 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 is a lot higher than what I'd get if I was just doing HMOs or buy-to-lets. And I think, you know, it depends on your circumstances. For me, that worked better because I'm in a position, you know, I'm young, I can take more risk, where for me, it's more important to sort of drive that capital growth rather than just sitting on an asset and being happy with the income sort of thing. So I guess that's the sort of point that you're alluding to there. It's
no doubt. You're saying I'm not young.
Well, you are. Christ, for what you've achieved, mate. Jesus.
But no, going back to your question, what advice would you give? I guess we're talking about younger people here knowing that property is a good long-term investment. I guess try and have some business around it then. So these people that are doing sort of like Airbnb sort of stuff, that's probably good. That's a much higher revenue rate, isn't it? It's a much higher return on investment. So yeah, have some sort of business aspect to it. Don't try and get into property with what money you've got on hot, because it's just going to deplete. You know, like you say, you're going to forget the development and you go back into buy and hold. You're going to run out of money like that, aren't you? So it's just like, try and have a churn rate, you know, do some flips first, maybe, you know, work with somebody that's done it before, because that can be fraught with problems if you've never done it before, as can anything really. So yeah, I totally agree with what you said, you know, build some cash first, and development's probably more of a business than it is property, because you're not holding on to anything.
Absolutely.
And you're actually churning capital, but getting the benefit of building equity as well. But development tends to be quite a high barrier to entry thing to do if you go traditional. But like I said, it is what it is, isn't it?
Yeah, absolutely. It's taking those first steps into, you know, a smaller project, little refurb. Yeah, in a way, I mean, for me, I was like my first deal. It was kind of, I viewed like tons of properties, and it was kind of looking at different properties and what worked for that individual property. I wasn't like, I'm just going to go and do HMOs, or I'm just going to go and do flips. It was like, I just want a deal. And I suppose when you're first starting out, you can take that approach. Now I would never do that. I wouldn't even bother viewing a 2-bed terrace, because it's not within my criteria anymore. And obviously now there's technology that you can filter through all that anyway, with the likes of property filter and stuff like that anyway. So it's a lot easier. But I suppose it's just taking those first initial steps to sort of understanding what you want to gain from business, property, life, I guess. It's understanding also what, if someone's sort of, I don't know, very successful, tons of money, just wants to put money into assets, then their approach is completely different to my approach, completely other side of the fence. So I think it's just understanding from your own perspective what methodology you need to use that fits your persona and what you want to achieve. And
I think you've touched on something really important there, your criteria. So many people kind of have a bit of a, when they first started out, and it's a typical entrepreneurial trait, is to kind of have that shiny penny syndrome.
Yeah.
So they're chasing lots of different things, and if one thing doesn't work, they move on to the next. Now that's a great sort of tactic, and it's a great skill to have, but you need to apply that to a narrow window of what you think you should be able to do and what you're passionate about as well. So like you're clearly more passionate about development than anything else. And like you say, the other stuff's boring and it's low return, and you're locking up equity. And again, what's your return on your equity? And I go back to this thing of what's your return on it, and it's much, much lower in a buy and hold strategy for property than it is a trading business or a business that's centered around property, to keep it relevant. There's more ways to skin a cat. And I do think traditional property is very low return, and particularly more so over the coming months. I think more people will get creative, and I think there'll be more competition out there, but I do think there'll be more opportunity as well. So it's just about seeing what happens, isn't it, I suppose?
Absolutely. Just to sidestep property very slightly, only slightly. What was the first sort of steps you took towards like making your first business acquisition? Like what was that kind of process, and what was the first business that you acquired?
That's a good question, actually. So I think it was, so first of all, it was the idea that actually now I've made a couple of sales, I've got a little bit of capital behind me. I could keep starting things and growing them and selling them, but like you say, I'll be dead before I make any significant money. So I thought, well, maybe I should just, and at first I thought I invest in other people's businesses, and then I realized that that's a long time horizon as well, because many of those were startups. So I thought, well, buying an existing business is much lower risk. Buying revenue rather than trying to organically grow it is obviously a higher return on investment, but it can be more risky depending on how you buy. So I thought that's what I want to do to cut down the time it takes. And then just started kind of sniffing around really, and sort of reading loads of books. I'm a big fan of reading books if you want to learn stuff, because it's practically free, or online, and just kind of going at it and seeing what we can make work. And obviously having the experience of been running businesses for 6 or 7 years before that, I kind of going into it knowing what needs to be done, and then building a team as well. So deciding, I think the first thing I bought, actually quite relevant, was it wasn't a rent-to-rent thing, but it was a business that had long-term leases on properties, a little bit like hotels do, and then would subdivide properties down and let them out. So I bought a business, and we sold it a year later, actually, and that was the first acquisition. And then it sort of got bigger and bigger from there as I got more confidence to, analyze deals and understand it. And then as my management team grew and I got more experience, it kind of snowballed from there, really. So I think within 3 or 4 years after that, that's when we were doing sort of deals in the millions then, from that first investment, which was about 50 grand purchase price.
I think that's a really important thing to delve into, because I think a lot of people kind of go from cold turkey to, I want to buy a £10 million business. It's been in the family for 40 years, and I want to use this option, and I've never used it. I guess there are anomalies, and people can pull them off. Absolutely, I'm not denying that in any sense. But I think people set an unrealistic expectation towards acquisitions, and it seems to be a growing market that's becoming more popular. So I think there's a really good example of how to go about doing it, which is, maybe a smaller acquisition. And it's the same process as property. You wouldn't just go straight in for a 60 unit new build estate.
Yeah.
You're going to have to do a small 2-bed bungalow first before you get to that point. And I suppose the process is no different whether you're starting a business, buying a business, or buying a property. So I think that's a really good point.
Yeah, and I think I probably jumped in too big at one stage as well. So we kind of tried to level up, and we bought this big business in haulage, and it didn't work out, and it ended up costing us, I think, just over £1 million. So I was set back £1 million from trying to level up a bit too quick. So we'd gone from, I think the last biggest deal was 150k that we bought, and then we jumped up and did a £1.5 million deal, and it didn't work. Various different factors that I can't talk about, many of which were out of our control anyway, but ultimately was a symptom of maybe going a little bit too big. And then the second time round, we knew what we were doing, did an even better deal that kind of wiped out the losses of that anyway. But that's just to kind of give you an example, maybe I was trying to go a bit too big, but we did start off small, to learn the legal, because the legal process is the same for a 50 grand deal as it is a £5 million deal, so you kind of can learn everything in an environment where you can control things if they go wrong, especially if you're starting out. So I think that's and that goes for property as well. So I think that's a really important.
How did
thing.
you navigate losing £1 million?
Well, you don't really think about it, and it was over the course of a year that I lost it. So it was like we had to spend on this, then on that, then on these fees for these people, and then on that. So it was kind of like, it wasn't like £1 million just disappeared overnight. But when we went back and calculated what we'd lost, I obviously felt a bit sick. So because it was cash out of our pocket, it wasn't like pretend loss or opportunity loss. It was actual money spent to try and save this thing. So it's, but luckily we'd built up the money to have that in the first place from, my own capital, lenders, partners, that sort of thing. So, it might sound stupid, but we had the money in the first place to be able to lose it. So it's we'll swiftly move on from that. But it can go wrong, and it does go wrong, and then that's where you realize, how much of a liability it is being a director of a business when things do go wrong. There's lots of a big, massive world of stuff that people don't realize, because it doesn't, luckily most people don't have to go down that route. But but it was good because it got us into the insolvency market, and we started doing turnaround projects. So there was some silver lining to it. I got lots of great contacts off the back of that. So yeah.
Oh, I'm sorry. I'll bring that up.
Well, it's I'm going to leave now. But it is what it is. But that's a learning curve, and it's a scar that helps me make decisions now that keep me safer.
Yeah. And I think it's amazing that you share that. And I think people listening to that need to understand that does happen, but you're still here. You're still alive. In fact, you're probably more successful because of what you went through.
Definitely.
And I think people are afraid of that scenario. But as an entrepreneur, as someone, that's always moving forwards, like yourself, prime example, you always bounce back with a bigger and better scenario, which is absolute credit to you, Nathan.
Yeah. And that business didn't have any property to fall back on either.
Well, there you go.
So there you go. So when things do go wrong, it's incredibly helpful.
Yeah.
But that's it's all part of just developing as an entrepreneur, I suppose, and as a business owner, isn't it? But that's it's important to remember those things though as well, so that you can make informed decisions going forward.
Absolutely. And you can't learn that from a book. You've got to
absolutely not
go through that process. Unfortunately, that's just the nature of the beast.
Yeah, probably should have had some sort of mentor or something, but I'd like to crash into the walls as I'm going along and figure, like somebody, I can't remember who it was, but somebody said, you're like a business explorer. And I thought that's actually ideal, isn't it? I'm just thinking, I'll try a bit of that. Yeah. I'm like at a buffet, I'll try a bit of this transport stuff, know nothing about it, but I'll try a bit of that. But we tend to buy in management that know these sectors. So I'm not just prodding at it thinking, I'm going to learn this, and a little bit less of building the aeroplane as you fall in now. That was at the start, but we try not to do that anymore. But just kind of diversifying in the right way, and keeping to our roots and stuff.
Absolutely. Amazing. I think it's all credit to you, to be fair.
Thank you.
You're one of those people that I look at in the industry, and I think although you're on social media, a lot of people that are similar to you aren't on social media, that are just people that are just cracking on. They're not shouting from the rooftops. They're too busy to do that sort of stuff. And I think anyone that's not following you should be following you in some format, because I think you are an inspiration for anyone that's in business, property, doing anything to look towards for someone that you should model your business career from. I'm not too sure about your own personal life. I don't really know that much about you, but from a business perspective, absolutely.
Yeah, no, we'll not go into that. But no, thank you. Yeah, it's just, I think, just be logical about it. Try and learn in a measured way. Read a book. It's don't go on loads of courses and things, because that's another thing. That's another area that we'll not go into. But yeah, you learn from people that have done it. That you can know and verify have done it, not just people that shout from the rooftops, like you say, because social media is a murky world. So I think that's another important thing. It's almost like you've done this a million times. So yeah.
No, it's great stuff. So I guess you've alluded to the Blue Bricks piece.
Yeah.
Just probably because we've had Sam on, of course.
Cat's out of the bag with that now.
Yeah, absolutely. And he obviously also spoke very highly of you on the podcast. So how did that sort of come? Because I know you were an early adopter of Blue Bricks, and you went away and then you came back. So what's the kind of...
So it's a funny story with Blue Bricks, actually. And there'll be lots of people looking at me, making sure I get all of this right. But because there's quite a few stakeholders involved with that business along the way. It's quite an old business, actually. We went into COVID, right? This was 2020. I think it was like April, May, something like that. And a lot of our businesses took a beating, right? So it was kind of trying to find ways to, I don't know, diversify revenue streams, things like that. And the property industry I was quite heavily involved with anyway at the time. That's probably my most extensive network is in property. So sort of that mid-tier kind of property investment space. So I thought, well, what's missing from the market really? And it was like a down-to-earth publication. And also thinking, what can we distribute that won't matter in this environment of COVID and lockdown and all the rest of it? So I thought maybe a magazine, because it's not like courses and things like that, and it's kind of like focusing on other people's stories. So I thought some kind of publication would work really well. So I got somebody at the time, my personal assistant at the time, Caroline. I said, "Do you want to start this business and actually go into it with me?" She was like, "Do I have to?" And I said, "Yeah, you do actually." we're trying to diversify. So yeah, nobody wanted to come to the party initially, but we started it. It went really well, and we kind of grew it organically. And when we launched it, we already had people waiting for it and stuff like that. So it launched really well. And it sort of like ticked along. We got out of COVID. I could get back into the proper businesses that were making money. And I'll be honest, it kind of lacked a bit of TLC. And I remember Caroline saying to me, "Look, can we have a meeting?" Because we had monthly meetings. And I came in and she said, "I think we're going to take somebody on to help out, in the office and stuff, and help with the writing and the media process and stuff." I said, "Yeah, good." And I said, "I'll let you find them because I'm busy." She said, "Oh, I've had this great guy recommended by a friend of mine." I was like, "Right, okay. Well, have you ever met him before?" "No, I haven't, but I know the person that's recommended him I trust." So we skip forward a few weeks and we get this knock at the office door, open the office door, and it's this lad, completely drowned because it had been pouring down with rain. He said, "I brought some coffees," and he was absolutely. And I was thinking, this is the caliber that you're sending me to. Yeah. So anyway, we brought him in, and it turned out to be great. And over time, kind of, it got assimilated with the business to a point where actually, because my focus was kind of away from this business, I kind of said, "Look, what's the appetite if you wanted to take over this business, And at first he was a bit hesitant, but he was practically running it anyway by this point. So I said, "Look, you can own it and make it your own, because it's kind of outside of our investment criteria anyway, and it was kind of an experiment over COVID." So I kind of persuaded him to take it on. and we did a deal. All went swimmingly, and then he sort of grew it. And he did really, really well, actually, Scott, and he kind of grew the business quite quickly, and then ran into some issues with funding and needing to do this, that, and the other. So I said, I'll come back into the business to help you out, and bring some capital to reduce his payments and stuff, and give him some money to do what he needs to do. And he just took off, really, and I'm glad I did, because he's definitely made a better go of it than what we did, and it's become a really sort of big name in that industry or sector, or whatever you want to call it, vertical. And he seems to be having a lot of fun with it, and a lot of like strong affinity from his audience as well. So who are credible people as well. Like, you go through and through the Blue Bricks network, they're all credible people. You only have to go to one of these networking events he does, like this bloody pigeons and property, or whatever it was recently, and it was lots of people having a laugh, lots of authentic property investors who were doing small deals, big deals, you name it, and they were all molding. And I actually got a text from him the night of that event, and he said, "Oh, do you know what, mate? Honestly, I've just kind of I clocked the event, everybody having a laugh, and I thought, oh, it's brilliant. It's a real atmosphere. It's a real community, which is what he's built. It's a community, and unlike, I guess, other publications where it's just a publication, this is really like a small subset community of people doing really enjoying themselves, and all paying the subscription fees, which is what it's all about. So, so yeah, it's he's done really well with that. Yeah, super proud of him. Yeah,
yeah. I mean, he's certainly someone that whoever I speak to about him, no one's got a bad word to say about Sam. So I think
he's a lovely guy.
Yeah, it's credit to him. He's, I mean, me and him have probably become quite close over the last sort of 12 months, obviously with the show and the synergies with the magazine. So, and he's certainly someone that I can talk to. I mean, speak of pigeons, I'm actually taking the real clay pigeon next week. So I'm going to go and do a bit of shooting between the two of us. So hopefully he doesn't point that thing at me thinking it's a laser still. So, but yeah, I mean, I think it just shines through the type of person that you are attracting, the likes of Sam, and obviously vice versa on both sides from his perspective as well. And I think that the industry is screaming out for more people of that ilk, and there are, and I think Blue Bricks does draw that type of crowd in. I mean, obviously the Blue Bricks Awards was amazing, brought some really phenomenal people together in a completely remote location, which was an absolute achievement in itself. So I think it's credit to obviously yourself being involved in that and starting it, and also Sam carrying the baton for sure.
Yeah, no, he's done incredibly well. Yeah, the awards were a fantastic event, caught a lot of attention from some key people, so he's looking at some big things at the minute. So yeah, watch that space, really. He's onto some good stuff. Yeah,
happy days. So normally I round off the episode by asking a final question, but I'm gonna tease the To The Point episode that we're about to do, so people can tune in a couple of weeks to listen to The Point episode. But if people want to follow your journey, how can they go about doing that?
Well, just leave me alone. I'm going to say I'm not selling anything. I'm not bothered. Don't send me a message. Right. Well, I'm on social media. I think I try and keep all my handles the same. So I think it's Nathan J Winch, as in the letter J. Yeah, but I'm everywhere, so come follow me. If you've got questions, don't ask them. But yeah, no, I'm happy to help. Yeah, I'm on social media, Instagram and LinkedIn are probably where I do most of my activity, but I'm on different channels. Yeah.
And if on the absolute off chance you've got a haulage business and you're looking to retire, then speak to me.
Speak to me, yeah, absolutely. Speak to me, and we'll have a chat.
Great stuff. No, I appreciate you coming on today, Nate.
Thank you very much.
Pleasure. Thank you very much for tuning in today. Obviously, a great guest in Nathan. If you don't follow Nathan, you really do need to. He's got a lot of inspiration around the business piece as well as the property side as well. Again, like I say in every episode, please do like and subscribe and leave a review on the audio version. I hope to see you again very soon. Take care.